What is an LBO? If you get asked this question in an investment banking interview, you want to watch this video to make sure you don't fail the interview. And make sure you stick around till the end of the video as well, because I'm going to reveal the key secret to a successful LBO transaction. You won't want to miss that, and you'll definitely want to use it in your interview as well. All right, let's kick things off with a high-level overview. What is an LBO? An LBO, or a leverage buyout, is essentially the purchase of a business using a mix of debt and equity. These are complex transactions, but for an interview you need a clear and simple framework. You need to avoid getting bogged down in details. I'm going to walk you through a 10-step explanation of what happens in an LBO. Are you ready? Okay, let's dive in. The first step is identifying a business to acquire. This isn't just about picking any company, it's about finding a strategic opportunity. Ask yourself, why will this work as an LBO? To do this, you have to consider the exit strategy. Is the company undervalued? Is there potential for a breakup, industry consolidation, or even an IPO down the line? For example, imagine spotting a manufacturing company that's undervalued due to temporary market conditions. You see an opportunity to restructure and improve operations for a profitable exit. This strategic vision is crucial in making sure the LBO is not just feasible, but potentially lucrative. Next, we need to value the business. This involves creating a detailed financial model based on various assumptions and scenarios. Let's say the target company has an EBITDA of $10 million, and the industry average multiple is 10 times EBITDA. This gives us a purchase price of $100 million. But we also need to analyse the potential returns to equity, the ROI and the IRR. If our financial model projects a strong ROI and a high IRR, it's a good indicator that this LBO is viable. For example, if we project a 20% ROI and an IRR of 25%, it signals a promising investment opportunity. Now let's talk about financing. We typically use a mix of debt and equity, somewhere between 40 or 50% debt and the balance in equity. This combination is crucial as it leverages the investment to amplify returns. We layer the debt into senior debt, mezzanine debt, and junior debt. On the equity side, we might have co-investment partners or even the management team. This structure not only spreads the risk, but also aligns interest across stakeholders. For instance, senior debt might come from banks, while mezzanine debt could be from private equity firms. Due diligence is the next critical step. We thoroughly investigate the company to ensure there are no hidden issues, financial, operational, market, or legal. This process involves scrutinizing financial statements, assessing market conditions, and ensuring all legal documentation is in order. It's like peeling back the layers of an onion to see if there are any unpleasant surprises. For example, discovering an unexpected liability could significantly impact the valuation and the terms of the deal. With due diligence completed, we move to closing the deal. We finalise the purchase using a multiple of EBITDA. For instance, if we buy a company with 10 million of EBITDA at 10 times EBITDA, the purchase price is 100 million, as we saw above. The deal is sealed and we officially own the business. This step also involves finalising the financing agreements and ensuring all parties are aligned and committed. Once we own the business, we implement our LBO strategy. This isn't just about sitting back and waiting for profits. We make operational improvements to boost performance. Let's say the company initially generates 10 million in EBITDA. Through strategic changes, we increase EBITDA to 13 million. Managing effectively also includes using cash flows to pay down debt and finance further improvements. This might involve cutting costs, improving sales strategies, or investing in new technology. As we manage the business, we collect its cash flows. For illustration, let's say the business generates a 20% free cash flow. These cash flows are used to pay down debt as well as finance improvements. There might also be an opportunity to restructure the debt and pay a dividend, providing additional returns to investors. For example, using a portion of the cash flows to refinance the debt at a lower interest rate can save money and increase profitability. After a period of ownership, we sell the business. We aim to sell it at a higher multiple of EBITDA if we can. If EBITDA grew from 10 million to 13 million, and we still sell at 10 times EBITDA, the sale price would be $130 million. Ideally, the multiple increases as well, further boosting the sale price. This might be achieved by positioning the company for a strategic buyer who sees additional value, or through market conditions that favour a higher valuation. From the sales process, we first pay off the remaining debt. If we started with 50 million of debt and paid down 20 million during the ownership, we would need to repay 30 million. The remainder, 100 million, is our return. This step ensures that all financial obligations are met before distributing the returns to equity holders. Finally, we assess the investment. If we invested 50 million and received 100 million, we generated a 2 times return on our money, or approximately a 15% annualized return over 5 years. This is calculated as the internal rate of return, the IRR, which we referred to at the beginning, a key metric in assessing the profitability of an LBO. For example, a 15% IRR indicates a healthy return on investment, especially considering the leverage used. So, to recap, the 10 steps are: 1. Identify a business. 2. Value the business. 3. Structure the finance. 4. Conduct due diligence. 5. Close the deal. 6. Manage the business. 7. Collect the cash flows. 8. Sell the business. 9. Pay off the debt. 10. Assess the investment. If you can remember these 10 points, you're going to have absolutely no problem with the interview. Now, I said at the beginning I would tell you the one thing that makes a successful LBO. The secret is that you make your money going in, not when you sell. This means buying at the right price and structuring the deal effectively to ensure maximum returns from the outset. By focusing on the entry strategy and ensuring a strong foundation, you set yourself up for a successful exit. Most of the deals that fail do so because the private equity buyers paid too much for the business. The RJR Nabisco purchase by KKR is a prime example. So, let's go back to that interview. Make sure that you keep your answers high level. Avoid going into too many details unless the interviewer asks. This approach ensures clarity and helps manage the flow of the interview. If you can do all this, you're going to ace it. Now, if you want to know more about LBOs, check out my Udemy course. I'll put it in the link in the notes. And if you found this interesting, my LBO course roadmap on YouTube will provide even more detailed information, and the link is here on the screen. If you enjoyed this video, please give it a thumbs up and consider subscribing to the channel. Hit the notification bell so you never miss out on more tips to grow your wealth and secure your financial future. Thanks for watching, and I'll see you very soon.